Are you conferenced out already? Not yet. Hopefully you have been having really great, interesting sessions and meetings. Welcome to this session on behalf of Finance in Common, of course, but also of GFANZ and GSG Impact. I'm Christina Tora. I'm Managing Director at GSG Impact, and I'll be the moderator of the first panel, but I'm also here to welcome you to this session on scaling tools to mobilize private investments in emerging markets. In this panel, we'll look at practical solutions, really, how do we do it to scale private investments to support the SDGs and the climate transition. In the discussion, we will cover solutions focused both on mobilizing domestic private capital, and that will be the first panel, but also on how we mobilize cross-border private lending and investment, and that will be the second panel. So we'll really focus on the opportunities and the potential for MDBs, DFIs, public development banks to develop, improve, and scale the most effective tools to mobilize private capital in emerging markets. And specifically, we're really glad to have collaborated with GFANZ on this panel. We have really complementary examples and solutions that we can bring to the forefront of this session. We'll showcase some key insights. We have started last year a working group on how we mobilize more private capital for SMEs in emerging markets thanks to DFIs, and so we'll share some of the examples that have come through this working group. We'll also showcase work of GFANZ's work stream on mobilizing capital and the World Bank Private Sector Investment Lab. And so we'll really look at collaborations and how we, might be able to scale and replicate some of the great solutions that you will be hearing from our panelists. But first and foremost, I would like to welcome our chair, Nick Hurd, for some opening remarks. Thank you.
Good morning, everybody. My name is Nick Hurd. I am chair of GSG Impact, and I'm here just to kick off proceedings. The exam question has been set. It's how do we become more effective at mobilizing private capital in emerging economies, and that has now become a mainstream question over many summits that you've attended, and everyone has arrived here informed and shaped by your own sort of personal experiences in this space. My background is political, my experience is political, and particularly in the UK when I led the work to do something ambitious in the UK around mobilizing private capital for impact. When we decided 14 years ago now to set out systematically to build a new market in the UK for social impact investment. And we dug deep into the tools that government have, and we work with partners to build a market now that is worth £10 billion of new capital that is looking to deploy for social impact alongside financial return, all enabled by deployment of public funds at the start of this process. So, of course, I'm informed by what is I know to be possible from lived experience with creativity and energy and some luck, but it's hard. And it's particularly hard in emerging economies, which is why it's so important to have this conversation, and particularly now when Remy and the team organized this summit. I'm sure they may have anticipated the second coming of Donald Trump. I don't think they could have quite anticipated what came with Trump 2.0, but clearly the context of this conversation has changed in terms of both the resources that are going to be available for supporting development more broadly, but also, frankly, for the challenge to those running public development institutions to demonstrate even more clearly the impact and effectiveness of what you do, particularly in terms of leveraging public assets. So this feels kind of even more important as a conversation. We're really delighted to be partnering with GFANZ. There's a bit of a David and Goliath situation. You probably all know who GFANZ are. I suspect some of you continue to travel in darkness in terms of understanding who GSG impact are. So let me take a minute to explain our relevance. We're a small non-profit that punches, we think, well above our weight in terms of our mission, which is to accelerate the flow of capital that is looking to combine positive social or environmental impact with financial return. That is why we have existed for over 10 years, and our model is a very difficult one to execute, but one which we think is enormously important. We, in effect, using language in common circulation at this summit, we effectively build national country platforms. And we do it now in 46 countries around the world, half of which are in the so-called emerging world. And our very strong belief, rooted in experience, that if you are serious around trying to change the habits of the investment community, trying to change the habits of governments, if you're trying to have a conversation around how these very different worlds of public and private can collaborate to create a more enabling and effective environment for investment to flow where it's most needed, where it can have the most impact. You cannot have these conversations in isolation. You cannot tolerate the silos. You have to break them down. You have to create the space for those national conversations that bring together public policymakers, regulators, intermediaries, the supply of capital, and the demand for capital. And that's what we do systematically, country by country, across 46 countries at this moment in time, with another 20 countries waiting to join this community, which tells you something about the appetite around the world for this conversation to happen because of the recognized need to get this right, to harness the power of the capital markets, to work alongside public institutions to deliver better outcomes. So all our insight and our energy comes from that network, that community that we have built, and our willingness and our ability to convene public development organizations, DFIs, multilaterals, to try and connect that insight and experience to that local expertise and experience. And to give you one very practical example, a primary issue for many of the national partners in our network, particularly in so-called emerging economies, I've just used that shorthand, is the old issue of access to finance for SMEs. I don't think anyone in this room needs a lecture on the fundamental importance of that issue. But let me put it very boldly. If you're an African development bank, chances are your number one issue is jobs for young people. And if you're thinking about jobs for young people, you're thinking about SMEs, and you're thinking about how to improve access to finance. And it's a long-standing issue that has not really been solved in decades. And our simple insight and the simple question we asked was, is this not time to take stock? Take a moment to actually reflect on decades of action and collaborate in trying to build common understanding of what has worked and what has not worked, and proceed forward with a much better understanding of what has worked, and have some discipline in applying that to new investments in new blueprints and new vehicles. And then our second question is to the DFIs, and we're really delighted to work with BII, Norfund and DFC as our core partners in that program, is could we connect this conversation to practitioners in local markets who understand those markets really well, can see the gaps, understand what is needed, and have ideas around innovative new financing vehicles that they think can be help you be even more effective in terms of your mission. And in Ghana and Zambia and Nigeria, we've done just that. So that's a little bit of how we work and why we care passionately about this exam question, and our passionate desire to connect global to local and local to global, which is the value that we think we add. I will close with just two reflections that have been brewing inside me for a while, and which I've heard expressed here, which I think I just wanted to dial up. I have been as guilty as many of thinking that the mobilization challenge could be boiled down to simple ratios and metrics of volume. And everything I've understood over the last few years is that is not just too simplistic a lens, to look at this challenge, but it's actually quite dangerous because it creates perverse incentives. I think there is a world of difference from being successful in helping to mobilize private capital in frontier markets, the most vulnerable markets, the fragile markets, than clinching a competed climate finance deal in India. I think there's a world of difference in terms of the value of that, in terms of impact. And I think the stewards and shareholders of development finance institutions, we need to help them understand the nuance of that in terms of the direction and the mandates that they give to those running public development finance institutions. The second instinct that is getting stronger and stronger is that there's a very, very real opportunity and very real need to bring domestic financial institutions more into this conversation. 2 or 3 years ago, what I was hearing was, how do we mobilize international private capital into emerging economies? And if all the work we've done through the Impact Task Force and other things tells us actually this is very, very hard indeed, because the barriers are very high, perceived or real. Whereas in many of the markets in which we operate, we see and we work with and we talk with pools of domestic capital that with the right encouragement, the right relationships, the right capacity building can be encouraged to deploy capital for impact in their own economies with a completely different perception of national risk. And that is a prize worth pursuing, and part of the reason that why we're here and why we exist is to try and help make those connections, help build those relationships, help build that trust and understanding, so that we can be even more effective in striking these partnerships between global and local, recognizing that on analysis that I've seen from, I think, the Systemic Blended Finance Task Force, that there are around $17 trillion today of pension fund savings assets in emerging economies, expected to grow to 45 trillion, treble or so by 2040. So there seems to us to be a real prize in opening this conversation up and working in real partnership and collaboration to try and facilitate these conversations and to have conversations around what works, because we have to be rigorously efficient and effective and push ourselves to really understand what works and back that in a context we're in now where there's limited resource and we cannot waste money, which is why we're so pleased today to be working with GFANZ to facilitate these 2 panels, deliberately structured to start with a conversation informed by local practitioners and national partners, and then in the second panel to bring to you insight from highly respected leaders of effective, innovative international institutions. And so we present to you this combination of the local, global, which we hope you will find stimulating, informative, and hopefully inspiring. Thank you very much indeed. Chris.
Thank you so much, Nick. In the interest of time, I will invite the first panel to come on stage while I introduce them and welcome them on stage. So please come as you go, and you have your names set out. So we will welcome Wale Adeosun, CEO of Kuramo Capital, Ibrahim Halil Öztürk, CEO of Investment Bank of Turkey, TKYB, Amy Yamamura, Chief Development and Innovation Officer of COFIDE, Public Development Bank of Peru, Juan Martinez Alvarez, Finance Expert of IDB, Anne-Marie Chisdero, CIO of FSD Africa, and Jeremiah Dan Okai, Head of Strategy and Policy of the Development Bank of Nigeria. Welcome to this panel. I'm really glad to be moderating this panel. And definitely thank you, Nick, for the kind of already the bridge and the introduction. So without further ado, you've heard why we're here and what we're going to discuss. I think this is a really exceptional opportunity to hear from practitioners who are working on the ground in the different markets on deploying capital to local projects, initiatives, SMEs that have an impact, but also collaborating with different actors, including international DFIs, private sector investors, to make that happen. And so I'm actually going to start with you, Anne-Marie. You have been operating in different countries in Africa for a long time. You have seen what are the barriers to deploy capital to SMEs and help them grow and create impact. What are those barriers, but also how have you solved those barriers with your activities at FSD Africa?
Great. Thank you very much, and delighted to be having this conversation and to have the invitation from GSG and GPANS. I've had I must say, a long career in trying to solve this problem, and as Sir Nick Hurd said, decades of DFI intervention into trying to address the problems of SMEs, which I think we all know: access to finance, access to markets, access to sort of the technical capacity, et cetera. And my reflection on this is that the financial system has actually failed SMEs. So we have to stop thinking about trying to address the specific sort of, what's the product that they need, what are the services that they need, and thinking about how do we unlock the financial system, because that's where the failure really is. We can't keep continuing to have these isolated interventions. And while the work of the NAVs is incredibly important, we need to integrate that work into actually deepening a financial system. So what do I mean by that? I mean, we need to address this issue of cost of capital. I mean, these SMEs can't pay the price of finance that is currently available. We need to address issues of liquidity, because the financiers want to be able to finance these companies, but also get their money back. We need to address the issues of better data, so that we can actually understand and price risk. And so our interventions need to be thinking much more around unlocking the financial system and enabling that money to flow to SMEs. So what does FSD Africa do? So we're an organization backed by the UK government, and we are a market facilitator, and we have a number of tools available to us. One is investment capital, which is what I run, but we also have the market building work of my colleagues. So what do we do in terms of addressing the problems for SMEs? One, we are trying to figure out different solutions. So deriving the solutions that are coming from the continent. For example, we're seeing a lot of what we're calling alternative local capital providers. And these are essentially investment professionals that understand their backyard, they understand their market, but they're using very different institutional structures. There could be investor networks, they could be small investment funds that are using sort of different types of funding solutions, but they're small. And how do they access capital? I think one of the problems that Nick Hurd mentioned was just scale. So, it's very difficult for these types of entities to access capital. So what do? We're trying to create a platform. So we take our own capital to demonstrate how to invest in these kinds of entities, and then use a platform approach. So you can be able to mobilize larger pools of capital into these intermediaries. Another thing that we're trying to do, again, solving the sort of deepening of financial markets, is looking at capital market structures and instruments. So we are testing a number of innovative solutions, such as listed SME debt funds. How do we do that? We do that by working with the local stakeholders. So Nick talked about the trillions that are sitting in the pension sector. How do we unlock that capital? We've got to engage with them. We have to, understand their requirements. We have to work with the policymakers. We have to ensure that they understand these new structures, that they understand how these new structures need to be regulated. So we've embarked on a journey in Kenya with the local stakeholders in creating a listed debt SME fund. So watch this space. Hopefully that comes off the ground very soon. we need to think about, for example, manufacturing is a big sector where there's lots of potential for SMEs. So how do we again stimulate a financial sector response? So we are going to be running a program called the Green Manufacturing Platform, where we're going to test different types of debt instruments with local financial intermediaries to these manufacturing companies. I mean, they could be e-mobility companies, they could be companies in the waste and management. So, but we're doing this alongside local financial institutions. So I think it's very important for us, when we're thinking about how to finance SMEs, to think about how do we get the local financial system to do that better? What's needed to address that problem in that market? Is it the need for more capital market type solutions, deeper bond markets? Is it need for different types of intermediaries and different types of products? But really thinking about a financial systems perspective.
Thank you so much, Anne-Marie, for all of these examples. I want to come back now to you, Wale. You have been also deploying several initiatives that are very innovative. One, which is a new one, the Impact Investment Wholesaler in Nigeria. We would love to hear from you, similar reflections on how you have been serving this market, especially the SMEs, and also the innovations at scale that you're going to implement for Nigeria and also potentially broader.
Thank you, Christina, and thank you to GFANS and GSG for inviting me. There's a young lady at GSG that everybody should try and hire. I think her name is Etienne. She got me to fly over 20 hours to be here. She was very persistent, so kudos to her. I feel like at Kuramo Capital, which we started about 15 years ago, we've been kind of like at the intersection of the conversations that are going on now. Our focus when we started Kuramo Capital was on private capital, mobilizing private capital for Africa, but I must confess it wasn't one that had a mission or intentional, like folks in the industry say, of impact. It was one that was just based on generating attractive risk-adjusted returns for commercial investors. Let me get rid of this, my phones, my apologies. It was based on generating attractive risk-adjusted returns for global investors, particularly US endowments and foundations. And we were investing in the US primarily. I was at the MacArthur Foundation and then Rensselaer Polytechnic Institute. And after investing in regions of the world that were growing really fast, China, India, Latin America, came to the conclusion that Africa was next, and that I knew a little bit about it because I grew up in Nigeria. And so we reached out to endowments and foundations, and they supported us to invest. And I think the key thing for us also was we strongly believed at the time that the private capital was where the bulk of the funds were globally if you wanted to make any kind of impact on the SDGs. So it's kind of like Wayne Gretzky saying that you skate to where the puck is. So we went to where the money is. And so they backed us, and we've been able to make investments across the continent. We have offices in New York, Lagos, and Nairobi. But one of the things we did when we started off, we wrote a white paper on the ecosystem. And we didn't like a lot of the players. One reason was, one, they didn't focus on small businesses, MSMEs. They were not on the ground, and they didn't really know anything about value creation really for all these companies. And so we started anchoring first-time funds. I wouldn't say it was intentional, but it was to get to a goal. And then we woke up one day and we realized that we'd anchored about 15 first-time funds, along with the DFIs that joined us in this effort. And we'd helped create over 650,000 jobs, impacted over 3.5 million lives. And we're like, wow, So this is a combination of private investments, actually trying to generate returns, but also making impact. And so, I mean, it was a gentleman at Ford that really revealed that to us. And then we said, wait a minute, we can really help really accelerate this model. Because I think everybody is now kind of coming to the conclusion that the fund of funds model can help accelerate the creation of jobs globally, which is what we're all trying to do. We really didn't have a structure around it. We just did it because it was what we thought was appropriate to do. But it required a lot of work initially with the underlying funds because a number of them didn't exist. And so we then decided that after what we'd seen, that we came to the conclusion that most of what we had done was really addressing 50% of the population. And because we only had one female-led fund manager in the group from Ethiopia. And so we've now put together a structure. So we created what we call a GLI initiative, where we put a structure around trying to accelerate the creation of first-time women fund managers. And to date, we've taken 45 first-time women fund managers through this accelerator. So our new structure and model is very simple. It's really A, B, C, D. It's not very sophisticated. But A is to accelerate, B is to bridge, C is to catalyze, and D is to develop. And so A is an accelerator where we've gotten some funding, grant funding, that has helped us take these 2 cohorts of women fund managers through. And B is the bridge, which is to provide either working capital or to provide funding for track record. So we're fortunate we partnered with 2X Global to provide bridge capital for track record and small foundation for working capital. And then C is to catalyze, and which is the fund of funds, which we're calling Moremi for the women fund managers. And then D is to develop or deepen, which is really to provide the back office and the shared services for this first-time women fund managers. So with the fund you're referring to, which is the Wholesale Impact Investment Fund in Nigeria, we're going to apply this model that we've developed to identify new fund managers across the country, provide the necessary knowledge in terms of the accelerator, provide bridge capital, and then obviously the funds itself. And I think we have an approach to how we want to talk to the local pension funds about how we can accelerate funding to these managers. And I'll touch on that later.
Brilliant. Thank you so much, Friday. Ibrahim, I would like to come to you now. How, thanks to your work at TKYB, have you catalyzed local private sector finance for SMEs, but also potentially for other initiatives and projects in Turkey?
Thank you, Christina. First of all, I am delighted to really be speaker in this panel. Thank you for GSG for your invitation. We are a development bank of Turkey, and we have been active in 3 line of businesses. One is the project finance, second is investment banking, and third is the equity financing via fund. And what we have done, of course, our funding is mainly from the DFIs, but specifically aligning with the DFI with our mandates. So on the SME side, we are trying to really funded by the DFIs through the even wholesale banking. We will try to use the banking or leasing companies in the project finance issues for the SMEs for the small tickets, especially less than $2 million. So we will use their network in order, since we have been at headquarters in Istanbul, in order to reach to the SME and for the ticket size of less than 2 million. We are trying using the other financial institutions, and we will, of course, in the affordable prices, of course, we will somehow give a kind of assistance to them for the ESG compliance as well, for the SMEs especially, technical assistance, let me say, in terms of the ESG. And of course, we are trying to use leasing companies as well. Nowadays, we are trying to use especially some fintech platforms in order to reach to the SMEs. But the obstacle is regarding with of course, we are getting hard currency funding. Unfortunately, these SMEs are in need of the local currency. For that reason, we will have that kind of, let me say, gap, and we will try to swap, but unfortunately the price will be some higher. But at the end of the day, we are trying using both the technology and the other financial institutions to be really included in this game. I mean, otherwise we are trying to really motivate them, and so that there's a kind of win-win. We are trying to reach the SMEs, and we would like to really to be more brave to this sector. The other thing is we would like to really include the financial, especially the development, especially the states, through the credit guarantee funds in order to get their guarantee as well. So, and we will try to use that for especially in order to have that kind of collateral. Of course, on the equity side, we are currently have a fund of funds again for the SMEs and the venture capital. Plus, we are trying to reach the venture, especially technological focused SMEs in terms of the equity financing. We are co-investment with the local and the international players, VC funds. So we will deploy almost $40 million of the, for example, and we have $50 million of the fund of funds. So we are trying to create that kind of ecosystem in the equity financing as well. That's what we have done, but we are trying to be more, for example, in the earthquake region, since we have that risk as well 2 years ago. For that reason, more disparity between the regions, especially in Turkey, we have that kind of disparity between regions in order to somehow decrease this disparity. We are trying to promote some areas. We have the refugee, I mean, especially almost 4 million people, Syrian people, so we are trying to promote with them with the grants and plus with some funding from the World Bank. So we are using all the DFI's money especially in order to motivate them, plus our capital. That's what we have up to now achieved, but we are still in need of that kind of, so we are in talk with the World Bank especially, and with Islamic development for food security in the SMEs, especially for the SMEs. That's what we have done up to now in our country, specifically for the SME funding.
Thank you so much, Ibrahim. Aimee, I was seeing you nodding and smiling. So can you talk a little bit about your model in Peru, how it compares maybe with what's happening in Turkey, and how you have been partnering with private sector and private sector investors?
Right. Good morning, everyone. Thank you very much, Christina, GSG Impact and GFAMS for inviting me to participate in this panel. It's a pleasure. So for us in COFIDE, Peru's Public Development Bank, we recognize that promoting and mobilizing private finance is critical if we want to close the infrastructure gap, especially in our case for water and sanitation. And that's an example that I would like to share with you today. In COFIDE in 2024, we issued a blue bond. And we did because we needed to finance water and sanitation programs in the country, because currently in the rural and peri-urban areas of the country, we have 10% of the population that don't have access to clean water and sanitation. And just to make, for you to have a better idea, we have almost 3 million people in Peru that don't have access to clean water, and 7 million who don't have access to sanitation, and that has a real impact in people's lives. So what we did is that we partnered with both water.org and with the FECMAC, which is the Peruvian Federation of Municipal Savings Funds, which includes 10 of the biggest and most important microfinance institutions in the country, which provide loans for SMEs. And we issued this blue bond, the first one in the country, that raised 100 million soles, which is approximately $26 million. And just to give you an idea, it had an investor demand that exceeded the offer by 2.2 times. So that is a real example of the interest that we currently have in Peru's capital market for this kind of impact-driven financial instruments. And I also would like to share with you three of the key factors that we believe made this issue of the bond so successful. And the first one was a well-established loan portfolio. Since 2017, we had this NGO, water.org, that had been working with the microfinance institutions in the provision of water and sanitation loans. And this gave us an ensured and efficient deployment of this kind of funds in the country. Secondly, we had a robust financial framework. So COFIDE, when structuring this blue bond, just made sure that it would align with international sustainability standards. And we also had a second party opinion, which provided more confidence to the private investors and transparency, and also assured that the bond would be aligned with the SDG 6 on clean water and sanitation. And thirdly, as we structured the bond, we made sure it was very market-driven. And so, for example, in terms of the maturity of the bond, we reduced it from 3 years to 1 year. And this in response to the microfinance institution demands. They prefer the maturity to be 1 year. And also, we set a competitive interest rate that would align to local investors' preferences. And so I think it has been a very successful experience for us in Peru. And just to share with you some of the impact that this project has had since 2007 and the importance for COFIDE as a public development bank to continue supporting it. It has allowed 1 million Peruvians until now to have access to clean water and sanitation through the provision of 321,000 microloans in the country. And it has also trained 9,900 loan officers, which will allow the project to continue to scale the outreach and ensure that it serves the most undeserved communities in the country. And lastly, maybe just also tell you that we are working on a second phase. We hope we can issue an additional blue bond in the country. We will partner most probably again with the FECMAC and with water.org, but we are also working closely with the Ministry of Construction, Housing and Sanitation. We believe that having the policy maker participate in this project is really important. So it is most likely that they will provide non-reimbursable funds, so we can create a guarantee fund that would also help to continue amplifying the access to these kind of financial loans, but to improve the financial conditions through which these loans are provided both to SMEs and finally directly to families. And so this is, I think an example that I wanted to share from our point of view as a public development bank in Peru.
Perfect. Thank you so much. A great example. And actually, if I may, I will move to you, Jeremiah, to hear from your experience to kind of wrap up the public development bank experiences. You've heard different tools already. I would love, or maybe we'd love to hear how your unique model at the Development Bank of Nigeria and having so many DFI shareholders has perhaps enabled you to collaborate and attract private capital investors in some of the work that you do, or maybe any reflections that you have on what your other co-panelists have said.
Thank you. Thank you, Christina, and thank you, GSG, for inviting me for this session. We're delighted to be here. As you would imagine, Nigeria is such a huge country, one of the top 3 economies in Africa, most populous country in Africa, 200 million. We have about 39 million MSMEs in the country. These 39 million MSMEs contribute 50% to our GDP. They employ 80% of our labor force. But guess how much private capital goes to MSMEs? If I'm being generous, 10%, right? The numbers are actually worse than that. So you have these very important economic actors who are very grossly underserved. Now, DBN, Development Bank of Nigeria, for those who don't understand what we do, we were designed and set up solely to tackle this particular challenge. How do we catalyze access to finance to small businesses in Nigeria? Under 7 years, we have done about $1 trillion in terms of disbursements to MSMEs, and we have impacted just under 1 million MSMEs in the country, just under 7 years. And I think it's just nice to share our experiences in terms of how we did that. Allow me bifurcate my thinking in 2 parts. One is how have we attracted private capital, and secondly, how have we catalyzed this private capital to MSMEs. So the first part in terms of how we have attracted capital. Now, at the equity level, DBN was set up, not just the federal government, but also in partnerships with the likes of European Investment Bank and the AFDB. So it's quite a unique partnership that, wasn't necessarily present at the time DBN was formed. So at equity level, you have those collaboration. But at the debt side, when we started, we catalyzed $1.3 billion into the bank to actually lend to MSMEs. And we had all the players in there from AFDB to European Investment Bank to African Development Bank. Now, in our second 5-year strategy, which we just designed last year, which is Amplify to Scale, we are also talking to these MDBs to catalyze funding both around thematic areas. So, for example, we're working with the African Development Bank to set up the first of its kind youth entrepreneurship investment bank that is focused on youth businesses alone. In fact, it's a baby of President Adesina, wants to set it up in 54 African countries. Nigeria is going to be the biggest youth bank that will be set up. It's a $300 million fund that will do equity investment, do guarantees, and do technical assistance. So that's one thematic area for youth. Another thematic area is green. 2, we worked with KFW. Just last year, we signed a $25 million line with KFW for green financing in Nigeria. It's also very important to announce that last year, we were the first and the only currently institution to be accredited to the GCF. $200 million would, level, which is a medium size, which will help us catalyze green financing to greening the Nigerian economy. If I also look at the gender line, we had, again, conversations with AFD last year, and we signed $50 million euro line for gender. So again, there are thematic areas and approaches that we're using to catalyze or crowd in funding from the MDBs. Now, how have we now catalyzed private sector to lend to MSMs? And I think it's very critical, and I'll just share with you our own examples. First, I need to say that the model of DBN is quite unique because we're the only wholesale DFI in the country. What that means is that we're a tier 2 lender, and we're at the heart of working with the financial institutions in the country. So call it the commercial banks, the microfinance bank, and other financial institutions. And we have 79 of them working with us. And why this is very critical, because if we look at the financing gap in Nigeria for MSMEs, the last study we did with the World Bank showed that the number is about 11.4 trillion. My entire balance sheet and the balance sheet of all the DFIs in Nigeria, if we put them together, we barely reach 7 trillion. So there's a funding gap of 11.6, and the entire DFIs can only do 7 trillion. So it only makes sense that you start catalyzing the private sector financing, in this case, looking at banks, for example, to use their balance sheet to lend to SMEs. And why this is important is when we did that same study, we realized that one particular year, just to take that in isolation, all the monies the banks put to treasury bills, which I consider lazy banking, was about 10 trillion. 10. So if we have 10 trillion in lazy banking, doing lazy banking, the question is how can we then catalyze that funding, right, and into MSMEs, because it's very critical. We've done that in terms of what has worked. We've done that in 3 ways. 1, partial credit guarantee. So we have our subsidiary called ICGL, and so we have a partial credit guarantee scheme, which a product called blanket guarantee, which is a hybrid between portfolio guarantee and individual guarantees, and we've used that to catalyze funding. We have issued about 100 billion worth of guarantees, but guess how much the banks have committed? 300 billion, so 1 to 3. And just by promising them that if it goes bad, we could cover 60%. So that has worked. And what has happened is that we've then, based on that guarantee line, we've impacted 60,000 MSMEs, created 160,000 jobs. The second important thing that has worked for us is technical assistance. Again, the reason why at the time banks don't lend to SMEs, they don't understand the risks, they can't even bother to stress themselves to understand the products and how to fund SMEs. And so we worked with the World Bank. We got Frankfurt School of Management. We worked with 5 banks. Now it's gotten to 20 banks. And we did a pilot of technical assistance, teaching them, give us your finance team, give us your risk team, give us your business development team. And for 18 months, we put them under those trainings and models that work for SMEs. And in that TA period, when we did our M&E, monitoring and evaluation, over 87% of SME lending had gone up in these banks that participated. We've had over 33% of accounts opened MSMEs. In the particular bank, for example, the accounts grew from 2,200 to 10,000. So it's working, but again, the banks will want to spend their money doing that, but our job is to ensure that we can offer those technical assistance to create the impact. And the last point I was going to raise is also product innovation. And in this particular one, came very closely during COVID. COVID, banks were in lending, and you will know that as a DFI, you want to be counter-cyclical to encourage lending. What we did was to tweak one of our products. And it became an LTF product, long-term financing, and that product could pass as a Tier 2 capital for the bank. And when we did that, boom, the banks, we catalyzed 150 billion that was lent to MSMEs. So these are some of the things that are working for us. It's a long way to go, but we think that these are some of the examples we could share. Thank you.
Thank you so much. Thank you. Great examples indeed. In a very short amount of time. Juan, I'm turning to you. IDB is a great example of, kind of shifting, transforming to prioritize private capital mobilization. Can you tell us more how it happened and what learnings can you share that might inspire others to do the same?
Sure, thank you. Good morning, everybody. I think it's a pleasure to be here. From the IBD perspective, we have a new institutional strategy. It's about impact and scale. You can have just impact without scale. So for us, it's very important to have this focus. When we talk about SME financing, I think it's super important to think about what are the critical conditions that we need to unlock in the local capital markets, in the local banking system to be able to mobilize way more financing for SMEs. And just very, very briefly, because I know we are short of time, from the MDB perspective, I think that we need to partner with local institutions that, in my view, are hugely national guarantee funds, which I believe have the highest potential to mobilize private capital. In our example, we have a couple of recent examples that I think are super interesting. During COVID-19, we had the opportunity to work with SIGA in Uruguay, which is a national guarantee fund, and we injected $80 million in capital. And with that, the guarantee fund was able to mobilize more than $400 million in financing for SMEs. Just to give you an idea, this is obviously $3.5 per IDB dollar, which I think it's a good ratio when you compare it with the average MDB mobilization, which is around 30 cents. That's to give you an idea that we're talking about 10 times the average mobilization for us, for our community, right? So I think that it's very important to think about this type of instruments in terms of unlocking capital, because SMEs is a risky business. It's a risky business to lend to SMEs. And I think that they don't have the track record in terms of credit history. They don't usually have the collateral. So when we ask the private sector to, yes, please go and lend more, we need some public side support as well, and I think through guarantee funds, which are quite heavily ignored in our community. I haven't seen many of them, for instance, here in Finance in Common. This is the best way, or one of the best tools, in my perspective, to scale the private investment that we need for SMEs, no? Particularly for the topics that we are discussing. If we want also private sector to lend SMEs for particular topics, not just generally, but do do climate, do gender, do this, do that. That's another layer of complexity we need to take care. And I think that with these guarantees, credit guarantees that go directly to cover potential losses of the private sector institutions, right? In case the SME defaults on the loan, this is a critical piece to re-engineer the system in order to unlock the private sector or to bring the private sector in. We have very limited resources, and if we don't leverage our resources with the support at the national level of this type of instruments, I think we will never reach the trillions, no, that we need to finance the SDG goals.
Thank you so much, Juan. Well, I have so many other questions for this panel, and we could go on and on. I think in the interest of time, because I think we're slightly running late, I want to make sure that the other panel has the opportunity to also share. And I think, Juan, your kind of comments were the perfect bridge to what we're going to hear on the other panel. So I would like, and I know you maybe prepared some kind of final recommendations because I asked you to do that, but unless someone has a really burning thing to say, I might just want to applaud this panel and thank them very from my heart to have. Oh, please, Wale, go ahead.
I have something burning because I flew 20 hours to get here. And I think it's along the lines of what Sir Nick mentioned, Jeremiah, and also Juan, but they were also mostly talking about debt. I think we can apply the same thing on the equity side. So, for example, the pension funds in Nigeria have about over 22 trillion naira, maybe about 20 billion or maybe 15 billion. If we're trying to get 5% of that, of 20 billion, say that's $1 billion we're trying to raise for the Wholesale Impact Investment Fund. We know that those pension funds invest 80% of their assets in government securities. So that's just buying government paper. Those government securities don't generate enough returns to cover inflation, so real returns are negative. But regardless, if we can give them assurance that we can guarantee that 20% for them, then we can then catalyze the portion of the investments they're investing in fixed income, right? So for example, if they can invest 5% of the 20 billion in private investments, that's $1 billion. If you can guarantee 20% of that, that's $200 million we need to guarantee. And then we have use of that $1 billion to invest in MSMEs. And we have the structure that I mentioned earlier, the ABCD structure, to make that investment. So identifying groups that are interested in providing this capital, I call it the replacement income model. This is Wale Adeosun's model. But people make it sound like it's a credit guarantee on fixed income. So, but the idea is to give the pension funds confidence that they'll get that 20% back at a minimum. We actually believe they can get even higher because the investments we're going to make, we're targeting 3x and 25% type returns. And so you can get that, but you unleash that billion. So that ratio is actually 200 to a billion. That's like 5 times, right? That you can unleash. And the leverage is very powerful. And then you can actually also catalyze additional capital from outside the country, private capital. We, with 500 million at Kurama, will catalyze $3.5 billion to the continent. So you can do a whole lot more from the private equity side. Thank you.
Thank you so much, Valerie. Thank you. Thank you to our panelists. And handing over to Ben. Thank you.
Thanks, Chris, and thanks to GSG for co-hosting this session. So Ben Weissman from GFANZ. For those who don't know us, GFANZ, we're the Glasgow Financial Alliance for Net Zero. We bring together financial institutions, investors globally interested in financing the transition to net zero. So I'm just going to call on all the panelists up here since we're running late on time. So we have Antti Kurunen from the European Commission, Ayan Adam from AFC, we have Hiroshi Mitano from MIGA, Leba from DBSA, I don't know what it says, ADBSA, Nazmira from 91, and Diana Layfield from BII. So if you'll all come up and join us. I'm sorry, the cards are updated. Perfect. So just as Christina and Nick earlier mentioned, this second session is really focused more on how do we mobilize cross-border or international private investment in emerging markets, and we're lucky that we have a really fantastic panel of folks from across the ecosystem, from private finance, from MDBs, DFIs, and public development banks. And I think the one thing I want to highlight here is we're really focused on scale. So how do we take what's working, how do we identify the solutions that we know have worked, and really understand the challenges that are still out there, and focus on how do we get to a much greater scale of impact. And I think there's been a lot that's been said and written about what are the challenges of getting cross-border investment in many emerging markets and developing economies, particularly from the global north. We'll hear a little bit about that from Nazmira, I hope. But I think we want to focus as much as we can on what do the solutions actually look like. So maybe starting first, sort of upstream, Lebo. DBSA has done incredible work looking at how do we grow the pipeline of investable projects. And we hear that a lot, that the lack of pipeline in many countries is kind of a huge barrier to private sector investment. So we'd love to hear more about what DBSA is doing to grow those pipelines.
Thanks, Ben. Pipeline. I think we do have pipeline as Africa in the region. There's no doubt around that. I think the key issue around it is, as you said, how do we consider a bankable pipeline? And I'll speak to the experiences from the Development Bank of Southern Africa, the role that we've played in creating a pipeline. I think there's two, I'll preface it with, you need to start with creating an environment that attracts investment and financing. And we've taken various approaches in that. One is, with the lack of infrastructure, it presents an opportunity for us to prepare them in a programmatic way. And we've got practical examples. I think a well-renowned program that we have pioneered within South Africa with the government, as well as the Ministry of Finance and Department of Energy and DBSA. We've got a RIP, Renewable Infrastructure Program, which with that we have almost about 6-7 rounds, and where we've procured just over 7,000 megawatts of renewable energy. We've also done the same with student housing, so it's across the board. We've started student housing about 4 years ago, where we had almost procured about just over 20,000 beds across 25 universities, and we are en route to start the development of additional 20,000 beds, also for universities and technical and vocational colleges. We've recently launched the Water Partnerships Office that would look into various programs with non-revenue water, wastewater treatment plants, and also we also look within the water sector. We also have reuse water. So there's various platforms that we've looked into the sector as it were, and in creating an enabling environment. Part of it, as I said, you've got infrastructure packages that you have, but also you need to look into the policy side of things that plays a critical role in enabling some of these things. For example, again, I'm going to go into the renewables, as it were. We've created a bankable instrument with a PPA that is, I think, known to many people, and with that, it has allowed foreign investment to come in. But I must say, one of the conversations that has come out in this is, how do you leverage domestic capital? With that, I think with bid window 1 to 5, we're looking at about 200 billion rand that was invested. 75% of it came out of South Africa point of view. There was earlier on spoke, how do we leverage pension funds? In recent years, we've seen the liberalization within the pension funds. So those are some of policy initiatives that we're looking into, and we continue to work on this. And in much more recent years, we've seen further liberalization within the energy side, wherein there's less requirements for licensing for energy. And we're now starting to see even private sector coming in, for example, within the mining sector, within the shopping center complexes, with the CNI commerce and industry, also also creating their own outside government, as it were. So those are some of the opportunities that we've done. So on the policy side, student housing, similar initiatives that we're still working very hard on. And again, we're also working on the water side in terms of changing how we can work. And with that also, within the policy, within the South African space as well, we've seen some of the initiatives from an essay to further liberalize on the water in terms of leveraging the grant coming out of government, so that they also help provide a certain base, and therefore that provides a good basis for blended finance instrument as it is. So those are some of the initiatives that we've had with enabling investment through a program. And there are some of the programs. We've got rail that is coming on road, so for passenger as well as for freight. So it's those are some of the things that we're looking into. Let me take a pause for the sake of time. Thanks.
Thanks, Lebo. I think a lot of really interesting solutions there, looking at a programmatic approach to grow the pipeline across a number of sectors. So thank you. Hiroshi, turning to you. So MIGA obviously exists for the purpose of mobilizing cross-border investment in emerging markets and developing economies. And last year, building on the World Bank Private Sector Investment Lab, you announced the establishment of the World Bank's guarantee platform. So how do you see guarantees, I guess, as effective tools to mobilize private finance? But then how do you see this platform as really being the mechanism for scaling that tool?
Well, first of all, I just want to thank you, Ben, personally, for your effort on the past year working on the Private Sector Investment Lab. I think the Private Sector Investment Lab was really the first time the World Bank Group had a dialogue with the private sector in a systematic way. Obviously, IFC, MIGA had their kind of dialogue, but really bringing in the policy side from the IBRD colleagues, IDA colleagues, into the mix is something important. We think that this whole World Bank Group approach is required to address the challenges we have in front of us. Just linking the discussion with Sir Nick's comments and also the previous panel, I think that job creation is an emerging theme that's coming across the whole world, not only in Africa, but really every part of the world that we need to address. And in the next, we're scheduling to have the next spring meetings in April, late April, but job creation will be the main theme. So I think that's critically important. As a result, I think the SME topics that we discussed in the previous panel will be critical. I think unless we have SMEs grow and therefore hire people, you don't really address a job creation issue. So the whole discussion that you had in the previous panel, I think, is really relevant. And my point of view is how can we use the guarantee platform to help that initiative? So one thing that we're trying to do is really help on the financing for the development banks. There were several on the panel there, but how can we help them raise capital, large capital, longer capital, cheaper capital from the international market? So that's something that I've been talking to a lot of our existing clients, new clients over the past few days. So, and I think there's a strong interest in using the guarantee platform to do that. Another thing that we're trying to explore is exactly what you were talking about, local capital markets. local currency. Financing infrastructure with US dollar does have its limitations. So how can we create the local capital markets within the countries is a big theme. So the new feature of the World Bank Group Guarantee Platform is I can now guarantee local institutional investors. So by providing the World Bank AAA credit, we can raise financing within the country to invest within the country. We call it local to local. So we're working in several countries with the governments in deploying those kind of instruments. So it's all those kind of things that we think it will be us capable to do through the World Bank Group Guarantee Platform. But the aim is really to create more jobs in each country. But just talking about your comment on equity, we also think equity is so critical. You create countries, you grow the pie through equity investment. So one of the themes that will come up in the spring meeting is really how can IFC help the private sector partners in putting more equity into the system. So just wanted to recognize that point also.
Thank you, Hiroshi. I think really exciting to hear kind of how do you use these tools that exist and how do you use them for kind of new purposes through this platform. So thank you. Turning now to Diana from BII, which has really been a leader on the topic of equity, but I think on a number of other areas in terms of deploying catalytic capital to unlock the private sector. So can you share more about BII's unique approach and perhaps what DFIs, MDBs, PDDs more broadly can learn from BII?
Well, thank you. I mean, as you mentioned, I think we're somewhat unusual among DFIs. Historically, our portfolio has been as high as 60% equity. It's about 50-50, and that's because all tools are required in this space. In terms of private capital mobilization, we are proud of where we've got to, and I'm actually very proud of all of the initiatives that have been shared in this room. In 2023, which is now some time ago, we were mobilizing at a rate of about 0.63, so about 63% for each dollar that we invested. That number is way higher for last year, both in terms of ratio and denominator. And I think it's great to call all these things out, but we are nowhere near where we should be. If you think about the scale of the gap, if you just look at climate finance, which, Ben, is obviously your field, if we look at development finance, we're talking about trillions of dollars. So I think there's a number of things we need to do, but I think the first thing we need to do is really raise our ambition here and make it really concrete in terms of numbers. So what should that mobilization ratio look like? It'll look different depending on the asset type. It'll look different depending on the market. But we're talking about multiples, not fractions, I think is the first thing. In terms of things we need to do, the first thing we've seen is you need to educate the market. Pretty much everyone in this room knows that emerging market asset returns are better than people think. Financial markets are not always as transparent as you think. I know someone who spent a lot of time opening up the market for commodities, selling commodities in investment trust form. And it took a really long time to educate even sophisticated financial investors on what those returns were really like. So the first thing I think we're trying to do that we need collectively to do is to call out things like, even in equity, emerging markets equity returns over the last 20 years have matched the S&P and they've outclassed pretty much every other index globally. But institutional investors surprisingly don't really know that. So I think there's an education piece. I think there's a lot we can do on partnering to risk share and working with existing capital markets. So we co-anchored 2 bonds on the LSE, the NMB Jami bond, which is a sustainability bond for a Tanzanian bank, for Helios Towers. Again, those were things that once sophisticated investors saw that there was an element of reassurance, that wasn't even really significant de-risking. They were prepared to pile in and invest on a fully commercial basis. The third is, this is a great Latin American phrase, originate to share. I would say we're only 30 years behind normal financial markets in this mindset. We can do a lot here, but we have to talk to investors. So I do think we have to be really careful not to sit in our kind of introverted state talking to other folks just in the development world. One of the things we're trying to do is engage with real investors. So one example is a project called Energrid that we've just set up with IndiGrid in India in partnership with Norfund and others. But we've made a $100 million investment. This is to drive green transition in India. It's around batteries and transmission. Battery storage and transmission is horrible, messy stuff that people don't love funding. But this, we believe, is genuinely commercial. And so we're essentially taking the first risk on this. Once we're at COD, this will list as an investment trust on the Indian exchange. And I am absolutely confident that that will attract completely pari passu commercial investors. So I think engaging with local investors like that, again, we're engaging with UK-based at the moment and some international-based life insurers and funds to say, what is it you actually want? We think we know what we want to distribute. You have to also come at it from, what are those guys looking for? How do we think about whether it's risk mitigation, whether it's packaging of assets? What is it that we can do to make these assets attractive to the commercial markets? And I think we've got something fantastic here that we don't usually reflect on, which is we can do two things that are hard. We can innovate together with the private markets. And we can innovate with each other and work with each other. If you're in commercial finance, pretty much, while a deal you win is a deal I lose. But in this space, it's not a zero-sum game. And I wonder whether we spend enough time just checking in on trying to make the world a bit simpler. What are we all doing that's really working? And how do we leverage those models across other institutions? And we're trying to do that. I know we're all trying to do that. I don't know what the right model is for that sharing, but I do think it's something unique about this area. And we need to work together and make it simple because we cover everything. We cover the full range of asset classes and the full range of markets. And so if you're an outside investor, that looks very, very complicated and very risky. And it's our job to make it not complicated and not risky. So I could happily list, N other transactions that we're doing, but you can read them on our website. And I just rather give space to the debate.
Awesome. Thank you, Diana. And I think a lot of really interesting things that you highlighted that BII is doing, but I think the point on how do we better share the things that are working, fully take. I think I'm going to change the order a little bit and call in Nazmira next, just because I think a lot of the points you talked about are points that Nazmira, trying to talk to investors every single day, but, based in an emerging market-based asset manager to understand what are the constraints, what are the needs from the perspective of asset owners. So over to you.
We do talk to each other as institutions.
We do. We do talk to each other quite a bit. Thanks, Ben. I think Ben has heard me give this lecture several times, so he figures if he gives me a platform, I might stop nagging him. I think, Diana, so much of what you said resonates because I think the starting point is if we want to mobilize large amounts of capital from asset owners globally, from inside emerging markets and outside emerging markets, we need to start off by meeting those asset owners where they are. And I worry too much that often this conversation is kept so far apart that that's not happening. I mean, that was one of the conversations in the first panel from FSDA as well. And so 2 observations. Our business, we manage about $160 billion globally. We started in South Africa. About 20% of that is in South Africa. 55% is in emerging markets globally. So a large chunk of our business is EM. And so our whole approach is very much around how do we help mobilize more capital. A relatively small proportion of our book is in direct. It still amounts to about $7 billion, but it's tiny compared to the total. And how do we grow that significantly? In the SA context, the problem that pension funds have is liquidity. You have a shrinking jobs market, and you have concerns on what the pool's going to look like in 5 years' time. And so therefore, as we've raised a South Africa RAND-based infrastructure fund, it's about how do we put in some liquidity into the system, and that's required the combination of direct loans with some listed infrastructure bonds to provide some interval liquidity. When we look at how we raise money from global asset owners in Canada or the UK or Europe, the biggest hurdle to overcome is a lack of familiarity. The perception of risk is enormously higher than the reality of risk. And if we think about it, the names that you see from the private sector in transactions in EM tend to be the same ones. So Nadia from Allianz is sitting back there. She's hauled the institution into any number of innovative funding. Temasek in parts of the world, CDPQ trying to do more with and slowly starting to make progress. But I have, to give you a picture, 91 in April last year launched an emerging market transition debt strategy, open-ended structure, focused on middle-income markets, financing high-quality private sector projects in hard currency. I would suspect everybody from a development bank in this room thinks there is no need for any sort of support because this is eminently fundable. And it is, for a bank, it was missionary work to get institutional investors into this fund. It was absolute 3.5 years of missionary work to get to $445 million where we are right now. It's showing signs of growing, as I said, open-ended, so we continue to take flows into that. But it was not an easy raise. To get lock-up money into middle income before you get to lower income and frontier requires some sort of risk mitigation. Because we're just not going to get the institutions in there the first time around without that. One large fund, I won't name which, that invested in emerging market transition debt. In addition to the process of the investment teams, the fixed income risk team, they got governance and reputational risk involved. That's the measure of what you go through in order to get the money in, to middle income infrastructure, energy transition investment. So if we're serious about scaling large quantities of capital into emerging markets and developing economies, let's start with where investors are rather than where we think they should be. I can sit here and say our loss rate over 20 years doing direct is 20 basis points a year, and that's 6 notches higher if you map it onto the Moody's default curve. Most institutions don't care. They can get 12% doing direct lending in the US. They don't care what my loss rate is. So how do we make the difference? And I think the answer is in the participants in this room, but we need to actually understand what the prize we're aiming for is and find viable solutions for that. It is possible to do. We have, as Ben mentioned, we have several vehicles where we've been able to blend or adjust, where we can actually begin to raise some reasonable amount of capital. But a whole lot more needs to be done. Because otherwise, Nadia and I keep sitting together at conferences saying there's just not enough happening.
Thanks, Nazmira. Definitely sobering, and I think, realizing that there's a long way to go to get institutional money at the scale we need in emerging markets broadly, let alone in some of the more frontier markets. So thank you. Maybe turning now to Ayan, I think it would be great to hear how, I don't know what your thing says, DBSA, sorry about that, how AFC Capital Partners, as an asset manager, is sort of bringing in institutional investors to the work AFC does to mobilize for infrastructure on the continent.
No, thank you so much. Just taking off from where Nazmira has said, I was kind of feeling bad. It took us 3 years to mobilize around 400 million as a first-time team in the context of infrastructure and climate. So we conceived the fund, but I think before I step back, I think there's another thing you said. Before you can really unlock institutional capital, you need to bring a strategy that's a unifier. And that unifier has to unify investors as well as your demands. For us, where we sit at AFC, our job is to unlock and develop the next generation of infrastructure. Infrastructure is key to everything that Africa needs. Without that infrastructure, we cannot develop SMEs. If you have the high rates in telecom, in power, in transport, we are disconnected in Africa. So a lot of people say if you give Africa cheap, clean, reliable electricity and internet, you solve the youth problem, because they will find a way to create the jobs. So 3 years ago we've created the Infrastructure Climate Resilient Fund. And this fund, I think, has a unifier theme. I think we are all affected by the impacts of climate. So it is the first really climate adaptation fund for the infrastructure asset class. No region has done it. We are raising $750 million. We have closed today with EIB, $52 million. We started this journey by looking at how do we raise this capital for such an important asset class, but in a climate-friendly manner, both low carbon ambitions, but also resilience. And we said, and we want to mobilize at scale, even if you're talking 750. Nazimira just said for South Africa, and imagine this is more sub-Saharan countries that are not even in the map of institutional capital. So I think we went about it in 4 critical ways. One is that unifier team, which is very important, but that's not enough. Institutional investors want scale. They want de-risk structure, so risk. They want return, and they want a differentiated product. And I'm going to just touch upon that as to how we constructed the Infrastructure Climate Resilient Fund. So this is the first fund in Africa that has the highest first loss. We were lucky in the AFC that we were accredited to the GCF as the first African institution. So we were able to first mobilize almost a $250 million in a first loss structure. And then what we did is we then look into the African private long-term savings. And we were then able to mobilize another, and we're hoping to get to up to 1/3. So 1/3 is a concessional capital. 1/3, we do believe that we can get it from the African pension industry, the private pension industry. And then we were able to secure the first DFI, and we will be also working with other European DFIs and few European institutional investors, as well as Asia. So that's the journey. We de-risk the fund. We have provided a layer of a de-risking. And this layer of de-risking has 2 features to it. One, it acts as a first loss. So in the waterfall structure, we pay the 510 to the private investors, and then you pay 10% hurdle. It's the highest hurdle also in the market. And then we pay the junior plus 3%. So it's got 2. One is that first loss cover, but second is that differential in interest rate structure that then enhances the return for the senior piece. So risk at the fund level, we're diversified. Then we are able to show the investors, based on our previous track record, that we can give you 15% US dollar return, provided nothing disastrous happen, and anything can happen. We do work with MIGA, and AFC has a tradition of covering, because we work in very complicated countries. So we're offering MIGA cover on some of our transport projects as well as others, so that the political risk is covered. So risk, return, scale. Just now, we want to have this fund 2 should be $1 billion. We want to offer the scale and reliability to institutional investors. We have embedded the concept of resilient infrastructure. What does that mean? And this is the differentiation. I believe we have some of the best team in the climate space and in infrastructure, inherent in the ICRF. Our parent is a leader in the infrastructure financing in the continent. We have developed some of the most successful ports in Africa. We are developing Lupido Corridor, which would link the entire Kobo Belt. So we have a track record. It has translated well for the institution in that we can place paper in the bond market. We have 14 billion that we have deployed in African infrastructure. This is not something I can go to an American institutional investor and they would buy, but our bonds are bought by institutional investors. We have kimchi bonds in Korea. We have samurai bonds in the Japanese market. We just did a listed bond in China. European market has been our best friend. European institutions have supported us from the beginning. So we're well known in Europe, but we haven't really gotten our foot in America, with the exception of DFC, which gave us tier 2 capital a couple of years ago. So I think this is how I think about it. We have to look at scalability and replicability. We gotta mitigate the risks to the institutional investors. And what are these risks? Political risk insurance, and risk that I won't get my money back and I won't get my return, right? If you can, so for us, we just take it block by block. Do I have a scalable project where somebody can put in 50, 100 million? Have I mitigated the risks that are in their mind? Very important. And do I have the right differentiated strategy? And for us, that is that we can create deals that others cannot create. We believe we have the best team. They're motivated to do well. And then third is that we come to the market with something that no one else has. And I think that, to us, is the way we approach the mobilization of finance at scale. Thank you.
Fantastic. Thanks, Ayaan. Thank you, Limo. I think a lot in there, definitely on scale, on de-risking, on not just de-risking, but ensuring that you're creating those returns that do differentiate, to Nazmira's points earlier, and then certainly on the differentiation and ensuring that it's in not just the theme that investors are looking for, but having the track record and delivering on infrastructure. So fantastic. And turning now, last but not least, to Ansi from the European Commission. Obviously, the Commission is doing quite a bit with the Global Gateway to mobilize private finance. So can you please share sort of some of the different partnerships, some of the different vehicles and tools that you're using?
Thanks a lot, Ben, and it's a pleasure to be here, and just also to say how pleasurable it's to speak after Ayaan, who has played a very important role on helping us to scale up sustainable finance as a very eminent person in our expert group that collected. So thanks, Ayaan, for that. So yeah, for us, of course, the scaling up is a key thing, and I think the first thing that I'd like to say is when you talk about the EU, you have to understand that you're talking of a rather upstream actor in the whole game. So we work with the BDBs, the MDBs, actors like in terms of being able to scale up. But there is that political objective that we have, and we can say it is sort of epitomized in the Global Gateway, our 300 billion offer to our partners, which we know that we can only pull off if we scale massively private sector investment. On Global Gateway, still maybe to say that, it's what we try to do with our partner countries is sort of create integrated investment packages. So we're not only looking at financial de-risking, but we're also looking at the perceived risk, country risks, and we're looking at how we can help develop the investment climate and business environment, the enabling environment around the investments. So that's number one. So how do we then go about scaling up in terms of leverage instruments? The backbone of the Global Gateway is called European Fund for Sustainable Finance Plus. Long name, but in short, it is a key tool to implement the Global Gateway. It's a powerful set of risk-sharing instruments, from budgetary guarantees to blended finance operations. In total, it's a 40 billion guarantee capacity, out of which 27 is for EIB, in fact, for sovereign and sub-sovereign operations. But that 13 that remains is for what we call open architecture. And it works so that we have our partners, the 20 or so European developed finance institutions, but also IFC, UN, CDF, African Development Bank, who are competing for guarantee capacity here. And so partners put out proposals, and based on that, the scrutiny, we have a board that looks at it, and decisions. We then allocate portfolio guarantees for the DFIs. And on these, you know, I think it's useful to maybe lay out a picture of three main categories. So these can be, first, project-oriented guarantees. So guarantees that de-risk infrastructure investment in sectors like renewable energy or digital infrastructure and transport and health. And typically they cover larger volumes and play a very critical role in Global Gateway, where we identify flagship initiatives that we want to finance. So that's number one category, and we have a number of guarantees of that sort. Second category is sort of intermediated SME lending guarantees, where we enable with our guarantee lending to local entrepreneurs via the local financial institution, and in the tables better conditions such as you know, collateral requirements less and extending maturities, and they are really key from our perspective to particularly put weight on underserved groups such as women, young people, migrant entrepreneurs, early stage businesses. So that's what we try to capture with this set of guarantees. And then the third element is investment and impact fund guarantees. So we support different types of funds through these portfolios of the DFIs, venture capital, private equity, in infrastructure finance, or green bonds. And these are, of course, quite powerful tools to mobilize private capital into impactful operations and innovative risk-sharing instruments. So what we're currently doing, that we have about 4 billion of guaranteed capacity out. We still have some remaining capacity, and we're looking at how these different portfolios are delivering in terms of mobilization, are delivering against Global Gateway objectives, and we don't need to go back and negotiate very complex guarantee agreements, but we can actually top up based on how we see the performance of these guarantees. So we can somehow try to steer in a sense, in the large sense of the word, the development by providing that kind of an incentive to also look at what is important from our perspective. One perhaps example that is interesting to talk about very briefly is what we are working with the EIB and a number of DFIs, the Global Green Bond Initiative. We are aiming to launch this year, and it creates a lot of interest in our partner countries. So the idea is basically to build and scale up green bond markets in partner countries and leverage also EU's quite strong track record as a green bond issuer. So first, we try to do three pillars. First pillar is try to work out a public-private investment fund that would act as an anchor investor, and then thereby also attract institutional private investors to come into this market. Second, we do a technical assistance program that we call Sustainable Finance Investment Hub. So helping the issuers with capacity building, also talking about building frameworks in our partner countries that are conducive for green bond issuance. And thirdly, also we are putting out a green coupon for subsidy facility so that we could support also the debt servicing costs that come from the green bonds. So this is the idea that we have, and we are very advanced on this, and I think that's something that we really have a lot of expectations in the near future to get this out.
Great, thank you, Antti. A lot of really exciting things, and really in a lot of ways helping support scaling of all these solutions being developed across the ecosystem. So thanks for that, and thanks to all our panelists. I think there's been a lot of really exciting things that have been shared. Again, how do we figure out how to scale all these tools across the board, work better across the system to figure out the solutions for the real challenges that we've talked about with getting institutional money and broader private sector investment in many of these markets. So thank you all. I'm going to turn now to Jean-Baptiste Sabatier, Deputy CEO of Proparco, for some closing remarks.
So thank you. Happy to be with you today. So I'm Jean-Baptiste Sabatier, I'm Deputy CEO at Proparco, so the private sector institution among the AFD group. I will not be too long, and I will only pick 2 words, but elaborate a little bit on these 2 words. But I know that we are already short on time. And these 2 words, I think, could summarize several points you mentioned during these 2 panels. The first one is confidence. I think definitely we need to build confidence. To build confidence, first of all, we can build confidence on our different track records. I think all the institutions which participate in these 2 panels are active now for a certain time, and we can show our track record and build confidence on this track record. I think to build confidence also, we have to rely on our client and our partners. For instance, what was mentioned in the first panel, when it comes to SMEs, you have to work, you have to help the ones which are really working with this type of institutions. So definitely the local financial sector, being banks or microfinance institution or even funds, it's also the way to build confidence because they know what they are doing. And then we have also to help them building confidence in themselves by, yes, demonstrating that, for instance, when you work with SMEs, that yes, it could be a risky business, but there is a proper way of doing it. So then it comes to giving them the appropriate financial tools and the technical assistance tool to help them be confident in themselves when they do this. And I think, yes, around this first word of confidence, it's really the cornerstone to be able to scale up the mobilization agenda and the finance flows we need to do so. Then I think the second word would be incentives. I think when it comes to incentives, first of all, is when we try to mobilize private investment, being locally or more internationally, we have to put our money at risk. That was what was mentioned. And I'm definitely really convinced at Proparco that the guarantee scheme are key now for the leverage effect they bring, for the fact that definitely also it's a way of sharing risk without paying for the risk at the very beginning. And I think what we are doing at Proparco with the EU, it's definitely a very strong way of demonstrating this. So the first incentive is to put our money at risk alongside the investor we want to mobilize, and guarantees is a good scheme. And then the other incentive would be, I think, and we have not mentioned it a lot during this panel, a little but not a lot, is also incentives through advocacy when it comes to regulation. I mean, for instance, you mentioned pension funds, for instance, to what extent DFIs and with certain of our, I would say, for instance, our mother company, AFD, in case of Proparco, we can really build advocacy to have regulation creating incentive for this money to be really invest where it needs to be invested, not in treasury bonds, but on infrastructure, on SME, etc. I know that even for DFI, a DFI like Proparco, we identify regulation constraints we have to fight. For instance, when we want to invest in financial institution, equity in financial institution abroad, our regulator told us, no, it's a kind of systemic risk when you invest in a financial institution in equity. I don't know, it's not a systemic risk. I'm de-risking the sector. I'm not systemic for Nigeria or for Mexico, etc. And then also at our level, we have to do some advocacy on the regulation to definitely create these incentives. And then to conclude, I would say, yes, we have to build confidence, we have to build incentive, but we have to try to make it simple. And we are not that good at making stuff simple. We are a financial institution, we don't like risk, etc., but we are so complex. So I think one of the big issue is to see to what extent we can make it a little bit more simple for the market and for the mandate we are trying to serve. So that will be for me. I assume you agree, but thanks a lot to the panelists.